Chapter 1. Normalized Financial Stupidity. Intelligence doesn't protect you from financial stupidity. Charlie Munger spent decades observing that smart people, doctors, lawyers, engineers, routinely destroy their wealth not through lack of brilliance, but through perfectly predictable, entirely avoidable behaviors that society treats as normal. The first stupidity is confusing income with wealth building. A high salary feels like financial success, so people scale their lifestyle accordingly. They buy the car their position deserves, the house their peers expect, the vacations their social media demands. What looks like prosperity is often just expensive cash flow with no accumulation. Munger understood that wealth isn't what you earn, it's what you keep and compound over decades. But modern culture aggressively normalizes consumption as achievement. Every institution profits from this confusion. Banks offering larger mortgages, car companies financing longer terms, credit card companies extending limits as rewards. The incentive structure is perfectly designed to keep intelligent people poor. When your employer gives you a raise, retailers are ready with financing options. When you get a bonus, luxury brands have sales events. The entire economic system depends on converting your increased earning power into someone else's profit before you can convert it into your own assets. This isn't conspiracy, it's just incentives working exactly as Munger would predict. The second stupidity is treating debt as a tool rather than a chain. Modern financial advice presents debt as sophisticated leverage, something smart people use strategically. Business schools teach that good debt builds wealth. Banks market debt as opportunity, and people believe it because the messaging is everywhere and the short-term feel is positive. You get the house now, the car now, the lifestyle now. But Munger saw debt differently, as a claim on your future freedom. Every dollar you owe is a dollar of future earnings already spent. Most people don't calculate the true cost, not just interest, but opportunity cost. That car payment isn't just $500 monthly, it's $500 that can't compound for 30 years. It's options you won't have, risks you can't take, opportunities you'll miss because you're servicing past consumption. The mathematics are brutal and simple, yet perfectly intelligent people ignore them because culture tells them this is just how life works. Everyone has a mortgage, everyone finances cars, everyone carries some credit card balance. The stupidity isn't in the individual choice, it's in accepting the normalized pattern without questioning the long-term mathematics. The third stupidity is confusing activity with progress. The financial industry thrives on this confusion. Trading apps gamify investing. Financial media breathlessly reports daily market movements. Advisors justify fees by showcasing activity. All of this creates an illusion that wealth building requires constant action, sophisticated strategies, active management. Munger knew better. His approach was almost boring. Find wonderful businesses, pay fair prices, do nothing for decades. But doing nothing doesn't generate commissions, doesn't create content, doesn't feel sophisticated. So people trade, rebalance, chase trends, follow tips, all activity that statistically destroys returns while feeling productive. The incentive structure here is obvious. Every transaction generates fees for someone else. Every trade creates tax events. Every strategy shift introduces new costs. The financial industry profits from your activity, not your wealth accumulation. They've successfully convinced people that sophisticated wealth management requires constant, sophisticated activity, when Munger's actual success came from the wisdom to sit still. If this kind of analysis makes sense to you, subscribe to the channel. It's content like this every week. Why do intelligent people fall into these traps? Munger identified several psychological forces. First, social proof. Everyone around you makes these choices, so they feel validated. Second, authority bias. Banks, financial institutions, and credentialed advisors endorse these behaviors. Third, availability bias. The costs are distant and abstract, while benefits are immediate and concrete. The culture reinforces these biases. Media celebrates consumption, not accumulation. Instagram shows the lifestyle, not the balance sheet. Success markers are visible spending, not invisible compounding. And because humans are social animals, we adopt the behaviors our tribe signals as normal, even when those behaviors are mathematically destructive. The most insidious aspect is that none of this requires stupidity. These are perfectly predictable responses to the incentive structures and psychological biases that Munger spent his life studying. The tragedy isn't that people are dumb. It's that the system is designed to make smart people act dumb, and we've normalized the entire pattern. Munger's mental model of inversion asks, what guarantees financial failure? The answer is clear. Spend everything you earn, borrow for consumption, chase returns through constant activity, and follow what everyone else does. If you want to ensure you'll never build wealth, those four behaviors will get you there with perfect reliability. This is why avoiding stupidity matters more than being brilliant. Brilliance might add a few percentage points of return, but stupidity, normalized financial stupidity, can destroy decades of effort regardless of how smart your investing strategy is. The mathematics work against you with perfect consistency. Consider the compound cost of normalized stupidity. A person earning $100,000 annually who spends $95,000 saves $5,000 yearly. Over 30 years at 8% returns, that's roughly $566,000. Not terrible. Now consider someone earning $75,000 who spends $55,000 saving $20,000 yearly. Same time frame, same returns, $226 million. The person earning 25% less accumulated 4 times the wealth by avoiding the stupidity of lifestyle inflation. The gap isn't about brilliance, it's about avoiding the normalized stupidity of scaling consumption to income. And this pattern applies to every financial behavior. The cost of financing a $40,000 car instead of buying a $15,000 car with cash isn't just the $25,000 difference plus interest. It's that amount compounded over the decades you could have been investing it. It's easily $200,000 in lost terminal wealth from a single normalized, stupid decision. If this is making you rethink your decisions, leave a comment. I want to hear your perspective. Munger understood that financial success isn't about finding the next Amazon or timing the market perfectly. It's about not doing the obviously stupid things that destroy compounding. This is why his mental models focused on avoiding mistakes rather than pursuing genius. The concept of negative compounding applies perfectly here. Just as wealth compounds positively over time, financial mistakes compound negatively. That credit card balance doesn't just cost you 20% interest this year. It costs you the compounding you lose from paying interest instead of investing year after year. The true cost of normalized stupidity isn't the immediate expense. It's the opportunity cost compounded over your entire financial life. Psychology explains why smart people ignore these mathematics. We suffer from hyperbolic discounting. We value immediate gratification far more than distant future benefits. The pleasure of the new car today feels more real than the abstract concept of $200,000 in 30 years. Our brains aren't wired to intuitively grasp exponential functions. This is why even mathematically literate people make mathematically stupid financial decisions. Another psychological force is what Munger called the Lollapalooza effect, when multiple biases reinforce each other. Social proof says everyone finances cars. Authority bias says banks approve these loans. Commitment and consistency bias says you've always done it this way. Availability bias makes the shiny car vivid while compound interest remains abstract. All these forces combine to make the stupid decision feel smart, and the smart decision feel weird or extreme. The financial industry exploits these psychological vulnerabilities systematically. They know you'll discount future costs. They know you respond to social proof. They know you confuse sophistication with intelligence. So they design products and marketing that trigger your biases while obscuring the mathematical reality. This is why Munger's approach was so powerful. He consciously fought against his own psychological biases, using mental models from psychology, mathematics, and economics. He didn't rely on being smarter than everyone else. He relied on having better processes for avoiding stupid mistakes. The practical implication is clear. You don't need to be a genius investor. You need to systematically avoid the normalized stupidity that destroys wealth. Don't spend what you earn just because you can. Don't finance consumption because it's normalized. Don't confuse activity with progress because the industry profits from your trading. Don't follow the herd because social proof makes it comfortable. These aren't sophisticated insights. They're obvious when stated clearly. But obviousness doesn't prevent people from ignoring them because the culture, incentives, and psychology all push toward the stupid behaviors. Munger's edge wasn't secret knowledge. It was the discipline to avoid obvious stupidity despite all the pressure to conform. The question isn't whether you're smart enough to build wealth. The question is whether you're disciplined enough to avoid the predictable stupidities that prevent wealth building. For most people, this is a higher bar than being brilliant. Charlie Munger's actual wealth-building approach would disappoint anyone seeking complexity. He didn't use exotic strategies, complex derivatives, or sophisticated trading systems. He did something almost boring. He avoided stupidity, spent less than he earned, invested the difference in wonderful businesses, and waited decades while compounding did its work. This simplicity offends people. We want to believe wealth requires special knowledge, insider information, or brilliant insights. We want the path to be complicated because that justifies why we haven't achieved it yet. But Munger's success came from ruthlessly simple principles, applied with inhuman consistency. The first principle: invert the normalized stupidity. If everyone finances consumption, you buy assets. If everyone trades frequently, you hold forever. If everyone scales lifestyle to income, you keep lifestyle constant and invest the difference. If everyone seeks complexity, you embrace simplicity. This isn't contrarian for the sake of being different. It's rational response to understanding that normalized behaviors produce normalized results, and normalized results for most people are financial mediocrity. The second principle: understand your circle of competence and stay inside it. Munger never tried to predict markets, time recessions, or find the next hot sector. He invested in businesses he understood, with economics he trusted, run by people he respected. This sounds limiting, but it's actually liberating. When you stop trying to be brilliant about everything, you can focus on avoiding stupidity within what you actually understand. Most people do the opposite. They invest in things they don't understand because someone said it's hot. They trade stocks based on news they can't analyze. They buy products marketed as sophisticated without understanding the fee structure. This isn't investing. It's gambling while using investing vocabulary. Munger would call it stupid, and he'd be right. The third principle: recognize that time is your edge, but only if you don't waste it on stupidity. Compounding works miracles over decades, but only if you let it work. Every stupid decision interrupts compounding. Every financed purchase takes capital out of the compounding cycle. Every trade creates tax friction. Every fee reduces what's available to compound. Young people have the most valuable asset: time. But they squander it by normalizing the same stupidities everyone else does. They finance cars because they have 30 years to pay it off, not realizing they have 30 years to compound instead. They prioritize lifestyle because retirement is abstract, not calculating that the small decisions now determine whether retirement is even possible. Munger's insight was that wealth building isn't about dramatic moves. It's about not interrupting the process. Don't take money out of the compounding cycle. Don't create tax events unnecessarily. Don't pay fees for activity that doesn't improve outcomes. Just avoid stupidity and let time work. The fourth principle, think independently about what you actually need. Society defines success through consumption markers, the car you drive, the house you own, the vacations you post. But Munger asked different questions. What actually improves my life? What's the minimum required for genuine comfort and security? What consumption is just signaling to people whose opinions don't matter? When you think independently, most consumption becomes obviously stupid. You don't need a new car. You need reliable transportation. You don't need a bigger house. You need adequate space. You don't need luxury brands. You need quality items. The gap between what society says you need and what actually improves your life is where wealth is built or destroyed. This requires psychological strength because you're fighting against social proof, advertising, and your own status-seeking instincts. But Munger demonstrated it's possible. He lived in the same house for decades, drove modest cars, avoided conspicuous consumption, not because he was cheap, but because he understood the opportunity cost of stupidity. The final principle, recognize that financial freedom is worth more than any consumption. When you avoid normalized stupidity and build capital, you buy options. Options to change careers, to take risks, to help others, to live on your own terms. Every stupid financial decision reduces your options. Every smart decision expands them. If this content helps you think better about money, subscribe and comment. It really helps the channel. This is why Munger was so dismissive of conventional financial advice. The industry sells complexity because it's profitable. Society normalizes consumption because it's comfortable, but neither complexity nor consumption builds wealth. What builds wealth is embarrassingly simple. Avoid stupidity, spend less than you earn, invest the difference, wait decades, don't interrupt the process. You don't need to be Charlie Munger to use Charlie Munger's approach. You need to be rational enough to avoid the obvious stupidities that destroy wealth, disciplined enough to maintain simple behaviors despite social pressure, and patient enough to let compounding work over decades. The path isn't sophisticated, it's just rational. And for most people, being rational is harder than being brilliant.